Not all Bitcoin ETFs are created equal. IBIT was the first, but BTCI is gaining traction. So which one actually puts more money in your pocket? In this video, we're breaking down the real differences from growth to income and showing you which ETF might be the smarter buy in 2025. So stay tuned. Welcome back to Simply Money. Today I'm going to be breaking down IBIT and BTCI. We're going to be looking at the difference between these two. I've done these for some other videos like QQQ and QQQI, SPYI and SPY, comparing the underlying fund to the high yield dividend funds and seeing which ones actually perform better. Today we're going to be looking at some Bitcoin and seeing how these are faring. Now, this is a very short time frame because BTCI has only been around since October of 2024. Again, we don't even have a full year, and in stocks and investments, a year is not a long time. Remember, this is not financial advice. This is for informational, educational purposes only. I hope you find these videos helpful and entertaining. As always, do your own due diligence. Make sure you know what you're doing when you're investing, and ask questions. Leave comments down below. I've gotten a lot of ideas from your comments. This was brought to us by several comments from different viewers who asked me to compare this one. If you have some funds you want me to highlight or compare, go ahead and leave comments there. Also, leave me a comment. What do you think about these funds? What are your thoughts on each of them or both of them? How are you approaching them? Are you invested in them? All those types of things. It's great here in the community discuss where they're at and what they hold in these. Let's start with IBIT. This is the underlying fund, basically a trust tracking the coin cost. It's not actually Bitcoin, but it's tracking the Bitcoin price, so it goes along with that price. You can see when we started out, and please give me a little grace. Sometimes the formulas pull the end of the month, and sometimes the distribution was made slightly before or after. These dates and time amounts may be slightly off, so I appreciate any grace. I do get some comments, and if there's errors, please let me know in the comments because that helps me improve and make sure we're getting accurate information. There may be a day or two off here. Feel free to look at that and verify anything that I have missed. But as we look at IBIT, you can see the price was at $39.78 back in October 2024. As of the end of August of 2025, we're looking at almost $63. We went up here. We had a little dip back in February, March, and then it started climbing again. Peaked up here at $66. It's dropped a little bit. But overall, from this date, we have a 58.3% growth rate in less than a year. So that's very remarkable, as Bitcoin is very high flying, but it can also be very volatile. So you have to be aware of that. On this scenario, like always, we're using a $50,000 hypothetical investment that would buy us just under 1,257 shares. And because there's no distribution with IBIT, no dividend or anything of that nature, your shares stay the same all the way down. This is what we're going to be looking at here. You can see the price, and that's all we're comparing on that with, because there's no new shares added, your shares stay the same. So our balance of the $50,000, we can see at the end of August has gone up to $79,148. It had peaked here in July at $83,000. But again, a $29,000 gain on a $50,000 investment in less than a year is extraordinarily good, and we want to keep that in mind. Now let's look over here at BTCI. And we'll keep this right about there. You can see the balance of IBIT. BTCI's cost, it started out at the same time frame at $50.29. Went up really fast in November, but then it started dropping, went back up. Then it dropped quite significantly at the beginning of the year, and then it's been climbing back up. So at the end of the year, at the end of this time frame, we're looking at August 20th, looking at 58.71 up from the 50.29. So that's a 16.74% growth, which is still really good in and of itself, but there's also distributions that are not added into that. And we're going to look at that here. Over here at this column, we have the BTCI dividend share. This is paying out on a monthly basis. You can see it started out at $1.13. We have around $1.40 to 50 cents each month. It's averaged $1.40 over this time frame. So that's a pretty nice, consistent dividend. It's not fluctuating a lot. It goes up a few cents, down a few cents, but it's a pretty healthy distribution on a regular basis. This is the amount of your distribution on the first month that we're tracking. You got $1,118 on your first month. But in this scenario, we are reinvesting it. What we do on these scenarios is we look at if you're reinvesting dividends versus the growth fund. So which one fares better if you're just doing growth and reinvesting dividends? And we talk about why would you even want to have dividends if you're not taking them? Because you're buying more shares. Here you have BTCI. With that distribution, you're able to buy 22 more shares. This is your total share count now, and your balance of the $50,000 is $51,119. As we look down here, you can see as this distribution grows, the number of shares you're buying continues to grow. You're up to 25. Look here, you got 30 new shares that month. Down here, 30 new shares, 28. You have total in this time frame gained 301 shares because you've been giving this distribution of $17,000 on top of this balance that you have, which is $24,000. But this has all been added back in here. So make sure you understand this amount is added in here because you took this amount, you bought more shares, that made your total value go up. Now this is your total value. If you compare reinvesting dividends versus just the growth fund, the underlying fund of IBIT, IBIT did better. We have just under $5,000 more, about $4,000. Oh, here it is, $4,175 more in IBIT. But you've gained 300 more shares, and some people don't understand that. They don't think it's wise. My opinion, for whatever it's worth, and you can obviously going to have to do what you want, what fits your goals, what fits your risk tolerance. If you're young and you're looking at years and years before you're going to need this money and retire, I would almost always focus on the growth element. If you're closer to using the funds, retirement, early retirement, whatever the case might be, or drawing that out just for additional income, supplementing your current income, maybe you're at a point where you're not ready to retire, but you want to take a less stressful job or a more flexible job, but it pays less, and you want to kick in taking some of these distributions. So if you're close to that time, using an income strategy may be more beneficial for you versus selling off shares. And that's what we're going to look at next as we look over here and say, okay, let's pretend, hypothetically here, we continue this, that we are now comparing that we're either selling off shares of IBIT to get the same amount that the distribution would give us of BTCI. With IBIT, we have 1,256 shares, or $50,000. BTCI is paying us that $1,118 distribution. To compare the apples to apples, we have to take this amount and sell that amount of shares to have the same spending capacity with IBIT. If we were retired, we'd have to sell off some of these shares. So you can see these shares are actually dropping because each month we're selling off the amount of the distribution that BTCI pays in order to have that for living expenses. At the end of this time frame, again, this is less than a year, with IBIT, we've sold off basically 250 shares because we're selling down these assets. Where BTCI, we're not selling down. Our shares stay the same. This 1,016 that we had, we're getting this distribution. We're not buying anymore, so this stays the same because we're not buying anymore, nor are we selling anymore. As we come down here, at the end of this time frame, you've averaged with BTCI almost $1,400 a month in distributions. With IBIT, we've averaged the same amount because we've taken the same amount out selling shares, but we've had to do it by selling shares, so we're down 250 more shares. Now let's compare this, our balance. If you're selling shares, your balance is still higher, 63,000, versus, well, I didn't sell shares, but it didn't grow as fast as IBIT, so I actually have less money but I still have the same number of shares. That's where a lot of controversy comes in. Throw your comments down below. What is it about having more shares that you're not selling shares that you like or don't like? Why do you go with the growth fund and say, I'm just going to sell shares? And what are the pros and cons in your opinion on that? I know there's a lot of different information, a lot of different reasons people do it, and you're going to have to make that decision again on your own. For a lot of people, they look at this and think, well, maybe so what? Even if I get down to one share, but that one share is worth $300,000 and I still have the same number of shares over here, the 1,000 shares, but it's only worth 80,000 or 100,000. I could sell a portion of a share theoretically to get more money. There are pros and cons on both ends. What are some other pros and cons you have to think about? Well, one is taxes. I don't usually show taxes on these because there's so many variations. For me, this is in a Roth account, not this particular one, but my income funds that I have are in Roth accounts predominantly, so there's no tax burden to worry about. But if you have this in a regular brokerage account and you're taking drip, you're paying taxes and then reinvesting. If this is in a regular IRA, you may pay some taxes when you take the distribution, but you're also going to pay capital gains when you sell these. So there's a lot of different tax implications with these different funds, whether it comes to you in a distribution as a return of capital, or if it's a capital gains, whether it's, what type of dividend it is, if the dividend is qualified or non-qualified. Those are aspects that change tax burdens. There's so many aspects. That's why I can't get into showing that. You'll take this same example and work in what your tax burden would be to kind of get a better idea as well. If you're in the accumulation stage, perhaps just going straight growth because you're not selling it, so it doesn't matter if you have capital gains or not in that until you sell it. Whereas if you're trying to grow it and it's not in a Roth or an IRA, a tax advantage account, say you just have a brokerage account, even though you're not taking the distribution because you're reinvesting it, you're still going to be taxed on that. And a lot of people may not realize that if I'm not in a tax efficient account and I get a distribution, even though I have my drip set on automatic, at the end of the year, that tax burden comes to you still based on whatever that distribution is, a qualified dividend, non-qualified dividend, return of capital, all of those things will impact your taxes. So you need to look at that as well. But I just wanted to share this with you, as always, give you the data from what we have, show you what it's looked like over the last basically year. We'll do another update on this fund and the other funds I've done every so often as we get more data, especially if we have different types of markets. In this period, this has been a pretty up market. We had the downturn in April. It was very short-lived, so we didn't get to see how will this compare in a recession, a 2-year downturn or something of that nature. So if we have a different market to compare, we'll bring this back up with the additional data. But I just want to present data to you, let you regurgitate it, let you look at it and analyze it yourself and make your decision. Do you feel more comfortable, even though you have less, that you're not selling shares? You don't have to worry about, well, let's look at right here in March. This fund is down to 52,000 and this one's down to 49,000. Well, if I have to sell here, I have to sell more shares to get the same amount. But on the other hand, with this being down, your distribution is smaller as well. There's factors both sides. Everyone's going to have their own opinion on this. Some of them are very strong opinions, which is great. I appreciate the enthusiasm. I appreciate you joining me and dialoguing and sharing. I appreciate the community that's coming together, sharing information, and I hope this is helpful to you. Again, throw the questions you have down in the comments. If you like this video, hit that like button. It really helps us out, gets more videos to other people, helping them find their financial freedom. Don't forget to subscribe so you're notified of future videos, and we'll see you next time on Simply Money.